Good evening, everybody. Hope you all well. Let me just mute my phone. Give me a second. So if you guys have any questions, you know where to post it. Okay. Let me just make sure that you guys can all see this. Okay. Good evening, everybody. Hope you guys can hear us well and see us well. Okay. Okay. Okay, let's get started. Welcome everybody. Good evening to this tonight's KopiTime. I am filling in for Benny Lee. He is taking his break. So it's just myself and Peter tonight. But tonight's session really is so we did this session earlier, I think last week, with some of the Mandarin KopiTime sessions. So we're going to repeat this for English. And tonight's session, I am your moderator. In fact, what we want to do is really ask Peter his experience being a fund manager. So I think we all have a lot of questions. And I'm here to moderate those questions that you guys want to ask Peter. Any questions on maybe how to become a fund manager? What is it like to be a fund manager? And for those who have just joined us or you don't know, Peter actually has he won I think it was a Lipper Award, right? Was it Lipper?
For Lipper Award is an award for unit trust to recognize the best performing unit trust. In various firms in multiple years, we did won quite a few years of awards on the basis.
Okay. But you were best performing fund manager in 2017, right?
There is no official recognition as best. What happened was I was featured on Bloomberg in 2017, and it was given that term was given by Bloomberg, not by...
Okay. But in that year, what did your portfolio returns look like, Peter?
I think for 2017, I think the return was around 42. It was 42%.
42% in 1 year, correct?
Yeah.
Okay. And I remember reading the Bloomberg article. It was around was it mostly on semiconductor stocks? Would you say that?
Actually, it's quite mixed. There were some consumer stocks within that also helped the return. But predominantly, you can say it's mainly the semi industry.
Okay. So you're the semiconductor seafood, right?
No. Again, that terminology was given by
me.
I'm far from the expert in semicon.
Okay. So you guys, I know I had my session this afternoon. For those of you who are just joined us, if you're new here or you haven't tagged your friends yet, please tag your friends. We are on here every night to entertain you about stocks, stock market investments, so you can become a better informed investor. We have had a few initiatives. If you're new to Equities Tracker, please send us a WhatsApp on 03-8408-2070 to sign up for a free account, or any slides that we had in our KopiTime, you can actually download it directly. I think Benny may have mentioned it yesterday. I think we are missing the net cash position that has since been uploaded on Monday, I believe. On Monday it was uploaded, so you guys can head on to 03-8408-2070. It's actually pinned at the bottom, and you can actually send us a WhatsApp, send us a hi, and then you'll respond, and then you just click 1 to go in and download any PDF that you like. So we actually have the full list of companies in a net cash position. All right. So to just to update, and then for those of you who have yet to add your friends to our ET Online Campus, please do. If you're a donor, if you donate 100 ringgit, you get access to our online ET Online Campus. It's a Facebook private group where all our learning videos are there. Both myself and Benny have 9 lessons each, 9-hour lessons. So there's 18 hours of packed lessons there all for you. All you need to do is make a 100 ringgit donation to any charity of your choice, or a charity that we have suggested. If you don't have one, you just need to head to charity.equitiestracker.com. We have raised over 100,000 in about 3 weeks. Thank you very much for your generous support. So if you're in and you donated 100 ringgit, but you have yet to invite your 3 friends, you have to invite them into the group. All right. And of course, show them as well how to actually get a free Equities Tracker account. You still have 9 more days, right, until supposedly MCO ends lah. We've had supposedly we've had some good numbers today. I think the last 2 days COVID cases were I think 38 yesterday, and then today's what, 50 something, right? It seems like it's coming down. But I think the Director General of Health also issued that there is a big case around the Selayang area. So if you're there, please stay home. Please keep safe. Okay. Yeah. So tonight, really, what we're going to discuss is really Peter's experience as a fund manager. I'm here to get all those questions in. So just punch in those questions to us. Tomorrow we have a very interesting one, because we've been asked so many times about gold. What do you think about gold? Then you ask value investors, what do you think about gold? Then all the value investors say, no, I never invested before. But nonetheless, I think it's up year to date, over more than 20%. I think year to date, gold prices have gone up. So tomorrow we actually have an expert. And also we have Li Chu back as well to talk about how you can get exposure without actually having to go to your physical goldsmith shop and buying those gold and storing it under your bed or your pillow. All right. So tomorrow's session. So please invite friends, your friends, if they like to hear about this. It is going to be an interesting session. All right. So let's get started. Maybe to get started, Peter, maybe you can sort of give us an idea how you sort of, actually got involved with. So if let's say someone like me, right? So I say someone like, or if let's say I'm an investor, I'm saying, look, I want to pursue a career as a fund manager. It sounds very, very sexy because I've watched Wolf of Wall Street and it looks really bad. Can you tell me how do we get into that, and what is your experience in the industry so far?
Okay, maybe I explain how I got into the industry. I got into this very purely by accident. It was a pure accident. I am an accounting graduate, so as with most accounting students, and of course, when we graduated, we always went into audit. I always tell this reality is when I first got my audit job on the first day, I regretted in the first 10 minutes of my life. I totally regretted in the first 10 minutes when I entered into the audit office. So that was in 2003. So over the next 2 months, every day I spent buying newspapers, going over classified. So that time, you still don't have broadband. So you still apply for jobs, flipping newspapers, sending your, those brown colored envelopes, pin up your resumes, right? So I did that. So then I saw a very small advertisement about a caricature about this company called iCapital, which honestly, I don't know what they do. But for me, that time, my main objective is just to get out from audit. So I applied for human resource, I applied for marketing, you name it, anything is on the classified, I just applied. So 2 days later, I got a call for interview by iCapital or Capital Dynamics. So I just went on. So that time, you don't really have fast-speed internet, so you don't really have a chance to do much research before go for interviews, right? So I still remember the first 2 questions they asked me was, have you heard about us? And my answer was no. No, I was quite honest that time. And then the second question was, do you know what we do? And again, my answer is no. I said, I don't know what you do. But somehow I got the job. Only then I realized what I got myself into. For those who actually want to get into the industry, it's a very small industry to be honest. If you look at the whole Malaysia, plus minus, you just pick plus minus. I think there are less than 500 analysts in the whole of Malaysia. It's a very, very niche industry because on average, be it your investment bank or your fund management houses, average you have less than 10 analysts per organization. So plus minus you get around 500, 600. I mean, it's just a plus minus. I never really go and count the physical head count. That is the reason why you don't really see job adverts for position as analyst or even or fund manager, because it's very, very close industry. The second challenge is somehow the industry prefer to hire people with experience. If you ask them to actually train someone new, to take a fresh graduate and train them, actually nobody really want to spend that time. They will just prefer to go and hire from somebody else. So we always, it's like a musical chair. You know, firm A will pitch from firm B will pitch from firm C, and it just keep on going around in circles and circles. It's quite, I mean, and that's the nature of the industry. Yeah.
So basically, you're saying that if you're a newbie, it's going to be quite a steep sort of hill to climb if you want to even get your foot in, right?
Unless, if you want a very, very honest answer, a politically correct answer will say, unless your resume is very impressive, that is something stand out, or a very unfortunate answer, which I'm sorry if I offend anybody, unless your father is who's who.
Okay.
No, that's the reality. You know, when I was in my previous employment, of course, one of it, I wouldn't name names. Very often you get CVs being submitted to me on my table, or by my email from the top, saying that look at this candidate, because he's who's who related to who's who and whatnot. But somehow I'm quite a nasty person when it comes to that. I will never hire a person simply because they are related to who's who. So in my whole career, I can say that, and I'm quite proud to say that I have never compromised on that.
Okay. So so either you have to be lucky, so that one you have to be born with it, or now actually this one actually ties in with Dylan asked a question. He said, do you have to pass module 9 and complete CFA level 3 only to be hired?
Okay. Oh, no. Module 9 and 10 is for license as a fund manager. Usually, okay, if you look at standard, okay, this is not carved in stone. Usually, you need at least to be an analyst first for at least 5 years, but it's not carved in stone, to gain the experience before somebody will consider, or the company will consider to promote you as a fund manager. Of course, I've seen cases where people are promoted fund manager as fast as 2 years, and some even after 7 or 8 years, they're still not being promoted as fund manager. So it's not a hard and fast rule that of 5 years. So you only need module 9 and 10 if you are going to get as a licensed fund manager. As for CFA, again, it really depends on the organization. I think the unfortunate part is all the financial institutions, not only Malaysia, right? Maybe Malaysia is not there yet, but you look at countries like Singapore or even US, right? There's this competition between the financial institution. It's like a trophy. How many CFAs I've hired, right? So they actually went on bragging within themselves. Hey, I got my organization, I have 50 qualified CFAs. They say, oh, I have 70. So it's like, who got the main number? But if you ask me personally, right, again, I'm sorry to say this, I'm a person that I don't really believe in CFA, to be very honest. I don't see the correlation between you having a CFA and you being a good analyst or a fund manager.
So what qualities do you actually see that? I mean, to be a successful fund manager, what qualities? If it's not CFA, and we know that's a very difficult thing to pass, right? But what qualities would you say that maybe as a fund manager, because you need to be good at picking stocks, right? So what qualities do you think someone should have?
I think if you read my second edition of my book, I get this question a lot. So that's why I wrote in one of the chapters, the new chapters that I wrote in my second edition. I have this chapter called "Why Do You Want to Be a Fund Manager?" So it is really, because I get that a lot. So whenever someone asks me a question is, how do I become a fund manager? How do I get into being a professional fund manager? The first question I ask them is always, why do you want to be a fund manager? I mean, it is a very important question, because you see, if your answer is, generally the answer I get is, because I want to be successful in my own investment. That means they actually, what they're trying to tell me is they want to be a fund manager so that they learn how to invest and how to manage portfolios, and in the end, they can benefit themselves by managing their own portfolios. The reality is, you don't need to be a professional fund manager to learn how to invest. I think that's a hard truth. which you see that certain hello or this certain like you said, the Wolf of Wall Street, right? People tend to think being a fund manager is a very glamorous position, very there was this halo effect on that. But I can tell honestly, being a fund manager, there's no such thing on that. In fact, it's a very stressful job. As you can see that I lost all my hair from it. It's definitely not due to Maggie Mee, it's not due to Ajinomoto.
Hey, wait. Come on. So I don't know about that.
So yeah, I mean, if you want to learn to invest, you don't really have to be a fund manager. But if your passion is for managing, for doing research to uncover undervalued and manage money for other people, I think that is the main reason why you should be a fund manager. So for me, what is more important is the character of the person. To be a successful analyst or fund manager, I think when I interview candidates to be analysts, I honestly, I don't really look at the qualification. I don't look at whether I have CFA. CFA to me is totally irrelevant personally. I don't really look at how good your result is. I look at the character of a person, which I think that is of utmost important, because I always believe knowledge can be gained, skill can be trained, but it's very hard to change the character. So if the person's character is not right, I think it is very, very difficult.
Okay. So I've got one question here from Florence Chin. She said she's a new investor, and she doesn't really know what good shares to buy. So would ETF be a better option, or would going down the route of picking your own stocks be just before you answer that, I just want to give a quick disclaimer. This is not financial advice. This is purely just a sharing session, educational. Okay. So please read our disclaimers. This is not a buy, sell, hold, any recommendation. There's no recommendations here. It's a sharing session, right?
Yeah. So what was the question again?
New to stock.
ETF.
ETF, or try and select my own stocks.
The answer to that question really depends on what is your investment objective. I mean, as an investor, I think a lot of people don't really understand. The first stage you have to do is actually not deciding what vehicle or what product you want to invest in. The first step is actually what is your target return. If it matters that if your target return is said, okay, I only expect to get 6 to 7% consistently every year, you're talking about a very different kind of products, right? If you're talking about, then you're looking more of those dividend yielding stocks, which are more safe, or even maybe an index fund which can actually deliver that kind of return to you. But if you say, no, I'm more happy with 10 to 15% return, then you're talking about a different type of products. But if you're super aggressive, I say I want a 20% return, that is again a very totally different type of products. So before we can really answer you which is better, I think the first question you have to ask yourself is, what is your expected return? Yeah, only then you can decide what product is more suitable for you.
Okay. So maybe so if say we're looking at ETFs, then what kind of returns should we expect if we're looking at ETFs?
Well, of course, on the
very big word, right? ETF is a very big word. So
it depends on the underlying assets of the ETF, because ETF really depends on the underlying assets. I mean, is it a US ETF or Malaysia? Okay, Malaysia we have ETF, but very famous, popular on that basis. So ETF is a very wide range. Actually ETF is just like unit trust. There are thousands over different kind of unit trusts in Malaysia, right? And so is ETF. It really depends on what is the underlying asset of the ETF. What are the ETF actually buying into?
Okay. So you got to find out what idea. Okay, so now we have one question here from Bradley, a top fan also. He said, "What was the most contrarian decision you have made as a fund manager?"
Most contrarian.
Yeah.
I think honestly, most of the stocks that I get the most returns are usually very contrarian perspective. I think I always tell people that to be able to invest successfully, you need to have a contrarian view. Not being contrarian for the sake of being contrarian. And there are people who just like being contrarian for the sake of being contrarian. I don't mean that. I mean, if you have done your homework, they are, right? I mean, disagreeing just for the sake of disagreeing. But what I mean is that if you have done your homework, if you have your certain views on things, and if you think that is against what the normal thoughts they are, I think that is worth being contrarian. I give a few examples. Like for instance, in 2007, I was saying that you should bet on fixed line rather than mobile. And that it was actually quite contrarian at that point in time. At a very, very early stage, I'm not sure if I should say this. Even some stocks, like to be honest, like 𝐷𝐸𝐸𝐻, right? I mean, we were actually one of the first ones to actually invest way back in 2010, 2011, when nobody even believed that what they can do or their services or make sense. So you need to have a contrarian view to actually gain that kind of exceptional return. But again, I'm not saying being a contrarian just for the sake of being contrarian. If you have enough research and justification to being contrarian, then don't be worried that if your view is against what the public is thinking about.
So we cannot blindly be greedy when others are fearful.
Yes, you can say that. Yes, you must know what you're being greedy about.
Yeah. Okay, this is a very commonly asked question. I get it so often from my classes. And okay, so here's the thing, right? So we get a lot of questions sometimes like, oh, EPF is buying or Corp is buying and selling. Oh, but this XYZ person is buying and selling. So Mei-Ling is asking, do you agree that a company where institutional fund managers are investors or shareholders gives us a strong indication that it is a good stock with strong fundamentals? So which means that you shouldn't find institutions in bad companies like fund managers.
Let me be okay. I'm trying to be as honest as I can in all my sessions. I think a lot of people go hit me for saying this. If you guys don't see me tomorrow or I'm being gunned down, you know what happened. Okay, let's be realistic. Okay, again, this is how the real industry works. Again, I apologize if anybody is offended. I'm just sharing my experience. Okay, coming from that part of the industry, right? You see, unfortunately, we always assume fund managers know what they're doing. They have done their research. They know what they're doing. Unfortunately, not really. Sad to say. Yeah, I'm not saying all. I think a majority of the fund managers, they are just relying on what the analyst is saying. So if you look at industry, there's two categories: the fund managers and the analysts. So the unfortunate part of the practice is that the fund managers don't really do much of the research, and the research they actually throw out the research to analysts. So all the time, if they want to buy a stock, ask analysts, okay, please do a research on this stock. Let me know whether is it buy or not. So they throw it to that. Okay. So and then the analyst will do, the analyst will then go and talk to the sell side analysts. See, there's a two type of analysts in the industry. Within the asset management firm where they manage, we have the analysts which serve the fund managers. We call them buy side analysts. And likewise, in the broking side, the one that in the investment banks, they have their own analysts. We call them sell side analysts. So then the buy side analyst will go and ask the sell side analyst for opinion which one they should buy. So what I'm trying to say is, unfortunately, it doesn't mean when there's an institution buying, it gives a certification that this stock is of good quality. Unfortunately, no. Because simply, for all you know, and unfortunately, it is true most of the time, the fund manager is just acting by listening to what the sell side analyst is saying. Right? If they say this is a company good stock, you should buy because of blah blah blah, and most of the time, the fund managers just buy according to that. So don't have an impression saying that whether is it the big giants of Malaysia are buying, they give a certification saying this is a very well run company. Absolutely no, it doesn't work that way. Yeah. If you don't see me tomorrow, you know what happened. Yeah.
Thank you for putting that case to rest. I get asked so many times. Okay. So we have that. Okay. Okay. So what are Actually, maybe okay. I'm gonna tweak this a little bit. Tony is asking, he said, what are the advantages of being a portfolio manager or analyst besides having access to company management? But I'm gonna tweak it to say what are advantages and disadvantages, okay, of being a portfolio manager, analyst. Yeah.
Honestly, I really advise people this. That is fund manager is actually a lousy job. It is really a lousy job, and really, really. You know why? You see, if you lose money for your clients, be prepared. No, they will actually put all the blame on you. You know, you're lousy. Why you're not able to make money for me, and so on and so forth. I met tons of them in my whole career, right? If you're able to make money for them, unfortunately, you don't get the credit as well. You know why? The credit goes to themselves. They will think that because they're smart for choosing you to manage a fund. So it's a lose-lose game. You know? when you lose money, you're screwed. When you make money for them, you don't get the credit. So it's really a very lousy job as a fund manager. That is the disadvantage. It's stressful. It's stressful. You get clients calling you 2 a.m., 3 a.m. at night, asking you about situations. I get that a lot during my career, but they are good, very good clients, I must admit. Very, very understanding clients. The advantages is, honestly, if you really follow ethics of a fund manager, I would say actually there's not much advantage to it. If you follow by the book, right, you do your work professionally, I don't really see there's much advantage to that, other than you're just executing your job as a fund manager. Of course, there are some that may be able to get some, some benefits out from there on the sideline, which I wouldn't comment too much on it. Yeah. But honestly, back to what I'm saying, that is really, if you are someone who actually really want to learn how to invest to manage your portfolio, there's absolutely no reason and no advantage for you to be a fund manager and learn as a fund manager. You can be well as a retail investor and learn how to build your own portfolio and give you a very, very good return yourself.
Yeah, actually, thanks, Peter. Actually, for those of you wondering, corporate access, that's what Equity Tracker is here. As you know, we feature many CEOs. So you don't have to be a fund manager for corporate access, and that's why we have Equity Tracker as a platform for you to do that. Just do join us, right? If you decide to join us after April 30th as a member, we welcome you, and that's really where you're gonna differentiate yourself from just a regular investor. Sorry, I need to do some advertising. Okay.
No. Go ahead. I totally agree.
Okay. Wow, this is quite a long essay. This is from Vinex Tan. Okay. If you could only name 5 quantitative aspects in picking stocks. Actually, I thought I misread. It's actually I thought it's qualitative, but it's quantitative. That means can measure into stock picking. What would they be and why?
I'm not so much a believer of income statement, to be very honest. This is what I really do when okay, maybe I can explain how I usually pick stocks, right? I read annual reports and quarterly reports. So I take the trouble to go through, wherever there's an annual report being released or quarterly result being released, I will actually take the trouble to actually go through one by one, actually pick up. So what was the filtering that I actually looked through was a few. I mean, the first filter I always look for is, the first thing I look through is always the balance sheet. Whether is this company a net cash or a net debt, yeah. Net cash is definitely the first interest which I like, because I'm not a believer of modern finance theories of gearing. I like conservative net cash. Second, actually, I look at is operating cash flow. Whether is the operating cash flow consistently positive. I don't mean, okay, when I say consistently positive means maybe out of 10 years, you got around 8 years that are positive. And it may not be continuously growing. I mean, it's really quite impossible to find a company where the operating cash flow just keep growing every year. If you find that, I think please let me know. I'm quite keen to actually have a look also, to be very honest, because it's really, really very rare. I haven't saw one before, unless it's via M&A every year. That's a different story. Yeah, it's very, very rare. Third, I look at is what is their capital expenditure. That means I'm trying to derive what is the free cash flow. Again, if it's a company that's considering free cash flow, again, that will spark my interest much further. Then the fourth, I'll look at the screening is I'll look at segmental report. you look at most companies, if you have various businesses under the notes to the accounts, you can actually look at the segmental report. Then what I'm trying to identify is what businesses they're actually in and which are the businesses that are actually generating most of the values to the company. Yeah. I would say there's only 4. I don't have a number 5 filter that I actually use for that.
Yeah, so if you want to another advertisement break, if you want to search for quantify what Peter has just said, sign up for equity tracker and combination numbers that Peter just mentioned, right? Today I'm here as a commentator, so I'm not. So I'm allowed to make a advertisement, right? Okay. Okay. I'm gonna turn to thanks, Peter. I'm gonna look at YouTube here. This is from YouTube here, Nicky Mike. I've got a Nicky Mike and I've also got Michael Oblivion. He's saying that as a value investor, how do you start your day? What kind of reading material or news should we follow or pay attention to in our environment or surroundings? Yeah.
Honestly, I shut down to Bloomberg, I shut down to CNBC, I shut myself down to mass media. The only 2 things I read is actually Financial Times and Fortune magazine. I think for any serious investors, these are the real 2 good source of information that one should read. I really don't follow Bloomberg and other media because you see, you must understand, for media, right, to consistently generate interest, they really need to sell bad news. Bad news sells. If you have a major headline which is negative, it will improve their viewership and whatnot. Yeah. So that actually create a lot of noises if you want to be a value investor. To be a value investor, you must be able to actually filter out the various noises that you're going to hear. So be very selective you read. And honestly, I like this too. To me, these 2 all the years have been must read in that sense. So how do I start my day? Again, maybe I'm quite involved in social work, so that also helped me to filter out all the noises here, because I really don't have time to actually follow all the news in that sense. I don't know what else from that sense. I hope I answered that. Did I miss out anything?
Nope. Sounds pretty good. I love Fortune. I've been a subscriber for many years now. I think you can get the e-copy on your iPad, or you can also get the physical copy as well. Yeah, it is pretty good. And one of the things that I find what's good about Fortune. Again, these are not advertisement. I don't get anything from Fortune. But they do get a lot of trends right most of the time. Quite ahead of time, actually, maybe 2-3 years sometimes ahead of time. So you read something today, you're gonna see it happening 3 years later. Yeah. I do agree. I do like Fortune. Okay, I got another question here. This is from, okay, so since you talk about noise, let's talk about noise a little bit. This is from Hannah Takziwa. She's asking, can you comment on what happened last night when we were asleep? Comment on WTI futures crash. Do you think there are any opportunity in Malaysian stocks?
Okay, maybe I need to clarify a few things. First thing you must understand, in the world there are 2 benchmarks for oil prices. One is of course the West Texas Intermediate, or we call it WTI, and the other is called Brent, right? Okay, how they differentiate in the prices is the location. WTI is mainly a US Oklahoma-based oil production. So when the selling price is based on the US area, which is mainly on the landed, whereas Brent is based on North Sea, right, which is more of a global. 2/3 of the world oil prices are quoted based on Brent and not WTI. WTI, again, if you were to summarize, is mainly on the US price on that basis. Yeah. The first thing is what you saw crash yesterday was actually the future prices. You see, every month there's a future prices. So if I have to summarize it again, try to make it as simple as possible, may not be technically correct. So for those all experts, if I'm not right, please bear with me. I'm just going to simplify the whole thing. Yesterday's is a contract for May delivery. It's a futures for May delivery. And it's going to expire, which is today on Tuesday. Yeah. Tuesday then, on Tuesday on their time. right? So what happened was, if for the sellers, for the May delivery, that was their last moment for them to decide whether do they want to take delivery of the physical. Because if they hold on to the contract, they have to take the physical delivery of the goods. But if you don't want, they decide to let it go. So what happened is, because in the US capacity, the tank capacity is full. So what happened is, these fellas, they are not able to receive it. So they actually pay people to actually take the oil away. So basically, that's what happened. If you look at the June contract, means to say the WTI based on June delivery is still hovering at around $20 per barrel. So it's actually not collapsing. So the one that collapsed is actually the futures for May delivery. Likewise, if you look at Brent prices, which is the more global prices, I mean, like countries like India and most of the Asian countries is actually based on Brent prices, it's still hovering around $20 per barrel. Of course, as we are talking now, it's dropping by 11% because of the fear factor yesterday. And what actually caused this overcapacity? It's not overcapacity. It's due to a lack of demand because of everything is locked down. So a lot of businesses are shut. So when the businesses are shut, there is the demand for oil actually drop. And when the demand of oil actually drop, the tank capacity is full. The storage tank is all full for all the oil. Even those tanks on the sea, on the floating storage are all full. So there's no way for them to take a physical delivery. And that's why they're actually willing to pay other people just to take it. But you see that also, on the other hand, it also signifies, we all know that US shale capacity has been growing every year. In fact, this year alone, shale capacity is expected to contribute 10% of global production. Bear in mind, US is already the world's largest producer of oil, even before this year. So if add another 10% of 8 million barrels a day, is going to be huge. So you can really understand why WTI is more susceptible to a price pressure because of production increase, storage limitation. Whereas if you look at Brent, they are more diversified. They actually Brent oil actually stored all over the world compared with US, because Brent are mainly on seas production, so they actually spread across the world. But whereas WTI is usually based on landed production in the US. So that again, that is the difference of why the storage situation is also very different for WTI and also for Brent. Yeah.
Actually, I also covered it slightly in terms of so I think one of the US oil funds ETF was actually, they had a 25% position of outstanding futures for the May contract. So they could have been the guys netting off their position. So because they hold such a big chunk, it was a very drastic push in price. So if you guys want more details, go and check out ET Online Campus, because how that can also possibly link to stocks as well. Okay.
That's one question I'd like to answer. Is it possible?
Please go ahead.
This is from Colin All. What are the bad experiences in your fund management? I assume my bad decision. I always believe there is really no value to share with you my successes. I always believe that it's more valuable to actually share my failures than my mistakes. And that's why, again, one of the chapter in the second edition, one of the new chapters of the 5 chapters, I actually dedicated one chapter to actually share with you all the mistakes that I've done as a fund manager rather than my successes. My biggest mistake, there are many of them, but if I would just put a very big grouping of my mistake is, most of the time I tend to fall in love with stocks, which is actually a very big mistake. What I meant was, when you invest in the stock and the stock did very, very well in terms of share price, but it's time to actually liquidate the position to take in profit. What happens is I usually find excuses for myself. I mean, I'll try to convince myself, why I should hold on to it, why the high PE is still justifiable, why the prospect is still good. It's a trap. It's a psychological trap that you actually tend to fall in love with the company. Then what happened was, of course, when the things re-rate itself, then you are not making losses, but there are some that I make losses, but most of the time is you have missed the opportunity to actually maximize your return, where you could have let it go at a much better price, but simply because of the falling in love with that stock, that it prevented you from actually selling at a price which is much better than what you could have done. I think that's the first bad mistake that I've done in my career. The second is actually when we start to price too much for growth. We need a delicate balance, right? Of course, if you go by purely a Benjamin Graham methodology, Benjamin Graham is no growth, meaning to say he will only analyze and value a company based on historical numbers. He put a zero factor to how much growth you can produce, because to him that is his margin of safety. If I look back at your history, if this is what you can achieve, if what I'm paying for is reasonable based on what you can achieve, then I'll buy for it. I'm not saying it's wrong, it's right, but bear in mind that theory came out in the 1940s when there is not much security analysis being done. So there is still a lot of inefficiency in the market where single-digit multiples is still very, very possible. Fast forward, look at it now. If you just look at Malaysia, how many single-digit PE on the trading basis that you can find? It is very, very difficult. So the other side of it is you have to factor in growth, which is how much growth that you're willing to pay for, how much growth the company achieve. So as an investment decision, you have to balance out between both. You have to look at both the trading and also you cannot ignore the potential growth. But my mistake that I always done is I tend to be too optimistic on the growth. I really admit that. So a lot of time where I factor in, say for instance, too high a growth, and when the company did not achieve that growth, it's still growing, but it did not achieve the growth that I expected. Because not the company's fault. I mean, honestly, it's my own over bullishness. You don't really make good returns out from that investments. So if I were to just sum up, these are the two biggest lessons that I've learned in my career. Am I still making the mistake? I would say yes, on and off. You totally cannot eliminate that kind of because investment is very psychological and very emotional. Just that you just have to keep reminding yourself that you have made this mistake before. How different is it this time? So you actually forced you to reassess the situation and relook at yourself.
Yeah, I agree. So how okay? So maybe the question is, do you think that you can learn that psychology, or you actually have to experience it?
Okay, that's a very good question, actually. Okay, I always use this. When I'm teaching in my school, I have a charity school. I always tell the student this example, right? I can tell you, for instance, I can tell you that kettle is hot. Please don't touch it. And because you trust me, saying that it's hot and you saw it's boiling, yes, you agree, it's hot, you decided not to touch it. But what you don't have is the experience of how it feels when you touch it. You will only feel how hot when you really touch it yourself. So if you're just listening to me saying that don't touch it, it's hot, the most you can do is just tell me, yeah, it's hot, I won't touch it. But what you lack is that experience of how it really feels. You know, what is that sensation? What is that pain? So I always believe that the best way to learn, of course, there are comments that say, learn from the one who have walked through the journey, avoid all the mistake, and that is the path to success. Somehow I beg to differ. I always think that experience is your best teacher. Don't avoid mistake in your life, because it is that mistake that is going to teach you something you're going to remember for your whole life. So never avoid mistake. In fact, welcome mistakes. Mistakes are actually the best teachers you can have in life.
Thanks, Peter. In fact, actually at Equity Tracker, we try and shortcut your learning. Sorry, this is another free advertisement spot. You want to learn experience in the shortest possible time, we have these two courses called your 𝐾𝐽 Master, okay? What we do is we put you through a simulated environment with real stocks, and we actually see how you trade, and then we'll churn out the report and we'll tell you where some of the mistakes, and that's the fastest way. I mean, yes, it's a joke that I'm talking about this, but I find that it's the fastest way you can learn through experience. Now, I learned this technique through looking at how pilots learn. Like, you see, a pilot cannot crash the plane and then learn from it and then figure out how they're going to fly tomorrow, right? So they learn it through a simulator, right? So that is a shortcut way or a safer way to learn experience, right? Like what Peter has mentioned. But yeah.
I saw a comment by Gilbert Lim. Mistake costs so much money. I mean, it is true. It's true. See, there are no free advice in the world, and there are no free lessons in the world. Cheap advice are never good. Good advice are never cheap. Likewise, good lessons are never cheap. Cheap lessons are never good. Okay, this is a personal friend of mine. I have met him 5-6 years ago, and I admire him because he is one that he learned investing at a very young age, and he made his first million in investing at the age of 21, and he lost everything in the age of 22. And it took him the next 7 years to build back the 1 million again. But that mistake didn't make him stop investing, or didn't make him saying that, okay, the stock market is bad, it's evil. But that experience of losing money, but which of course he didn't give up and he went back again, and that served a very good experience for him of what not to do in the subsequent years, that allowed him to build back the wealth that he has.
Okay. So Peter, we have this. Actually, we have a few questions on this. During MCO, how do we buy your book? Do you do personal deliveries? Can we just give out your handphone number?
You can actually Facebook Messenger me. My Facebook is Peter Lim TC. You all can see there. I just managed to find one courier near my house today, so actually can actually courier out. Yeah.
Yeah.
And the path to the courier, actually there's no police or military block, so it's still a very safe path. So I just found today, to be very honest. So it is possible now because I found the courier that works during this period.
Okay, so you got the answer, right? So but if you want his personal number, is for sale, just PM me. I'll sell you. You can call him at 2 a.m. and ask him what do you think about this stock.
I'm going to change number very soon.
Okay. Okay. So look, I have a lot of questions coming through. I probably can do maybe 3 or 4 more. Okay, so I'm gonna take questions from someone we haven't answered before. Okay, because I know some of you guys have very long question. So let me try and see. Okay, let me see. Okay, so this is probably a bit more of a personal side, but how has being active in charity actually changed your approach to being an investor? This is from Chi Ho Lim.
I think okay, I always tell people, right, that there's a big difference between a human being and being a human, right? So actually what we need as a person is actually not to be a human being, but actually being human. When we always try to say we always want to do charity, or we call it we do charity, right? Say for instance, we help another person. We always tend to think we are actually helping the other person, right? We're actually providing help to him or her. But what actually we don't realize is you are not helping anyone but yourself. It's not about talking about merits, it's not about taking afterlife, but at the end of the day, you start to realize that you develop compassion within yourself. You develop humanity within yourself. You're being a more compassionate person. You're being a more understanding person. So the act of helping, actually, you're not really helping that person because the end beneficiary is actually yourself. And then why is this important is you look at it, this is a finance world, and investment is a pure money world. It's pure monetary world. You talk about gains, profit, how much you can make. And if I've seen, you tend to lose yourself in this cycle of everything is about monetary gains, right? But having more humanitarian, being more human within you, right? That will actually allow you to see things from a wider perspective, not purely profit driven. Of course, you have to generate gain, but there are also other factors to consider. You're being more realistic in your expectation. You're being more overall, you tend to see things from a very different perspective. More realistic, I would say, in a more realistic approach, and you tend to be more reasonable. I think a lot of investors are very unreasonable. They expect miracles from a company. I give one example was there was this analyst briefing from a telco company, which I shan't name names, many years ago. So then I actually asked the CEO, how much can you grow next year? So CEO said, okay, I can actually grow 15 to 20%. Bear in mind, this is a telco. A telco can grow 15 to 20% is pretty impressive. But then the analyst was asking, why is your growth so low? Why can't you achieve higher? And what's interesting, how the CEO answered. The CEO said, well, if you think you can do a better job than me, then please come and take over my position and you run the company. Right. Yeah. So yeah, I think it helps you to have a better perspective of things. Yeah.
So if you want to get a better perspective of things, donate 100 ringgit and join ET Online Campus. This will also give you a good perspective to things as well, right? Yeah, do your part for charity. And our charity drive in 2.5 weeks have raised over 100,000. So thank you very much. For those who have just joined us, while we are locked down, best time is to actually spend some time learning. So we have some really, really awesome content. I think those of you who are online right now, they have attended the content. Maybe you can say something to those that have not attended. We've got some really awesome content online. We've given it away for free. All we want you guys to do in exchange is actually don't forget charity, because in this lockdown situation, there are a lot of people that are worsely affected than we are. So all we need you to do is just donate a minimum 100 ringgit to any charity, and you can bring 2 friends along, right? So please be generous with that, and there is a lot of value in the group that we have created. Yeah, so we do hope that you sincerely can join us. Okay. Okay. So this is from another top fan of ours. Because I haven't answered this question yet. So this is from Joe Kwa. He said, is a fund manager allowed to invest in his own personal portfolio, or is there a conflict of interest?
It's a good question, which I also put it in one of the new chapters in my second book. Actually, my second edition is quite a controversial book. I tend to step in all the new chapters. I tend to step on somebody's toes, from industry people's toes to academics' toes, you name it. Okay, if I put it straight, right, there are regulations to SC or Securities Commission, the one that regulates the industry. They do allow fund managers to invest, but there are conditions. Meaning to say, for instance, the most common condition is if your fund manager want to buy a stock, you have to submit a approval list. You must indicate what company you want to invest in to a compliance. Then what compliance will do is they'll actually check whether would there be any trades of the same stock on that day, or even 2 days before or 2 days after. So actually it's quite, and how many days before, after, it depends on the company's own internal policy. Then if there's clearance, then your approval to purchase or sell is only applicable for that day, from 9 to 5 that day. If you don't do it on the next day, you have to do it over again. And of course, you have to keep a compliance log, and then there will be an audit or ongoing audit to actually check. So there are regulations to allow you to invest. It's not a crime. But for me, I don't. I always believe that it's a matter of ethics. That a fund manager shouldn't be investing on his own. To me, it's an ethical issue. Because see, humans being humans, right? If I want to find a way to do it, I would create the opportunity to do it. I mean, let's be very realistic about that. Humans are very creative when it comes to want to bypass certain things or certain ways. That is why for me, it's more of an ethical issue for me personally. That is why I don't really believe, or I don't really encourage fund managers to actually invest on their own when they're managing. So what I did last time was, if I'm managing a unit trust, which is a public fund, the only thing I'll invest is the unit trust that I'm managing. So I actually will put my money together there, so that I'm actually aligning my interest with my client's interest. So if I screw up, look, we all screw up. I screw up myself also. But if I'm able to deliver return to you, I also benefit. So while I was managing unit trust, my only investment was via the unit trust that I manage. Yeah.
Okay. Good question. Okay, so we got this question from YouTube here. This is from Michael. He's got a few, so I'm just gonna summarize because I think you've covered some of them. Okay, what are your thoughts about? Okay, I'm rephrasing the question. About the whole pump and dump. Okay, so for those of you not familiar, pumping up meaning you push the share price up just to sell. So at ET we call it buy to sell, sell to buy. Okay, what I mean, not just locally. Maybe can you comment? Are there cases where there is a pump and dump even in the professional scene globally, right? Are there usually a moratorium on these kind of actions?
For a professional asset management firm to do pump and dump is actually quite hard. not possible because, see, everything is monitored by Securities Commission. Even your buy volume, your sell volume, everything is. I mean, they are keeping an eye on the whole industry. So honestly speaking, it is very hard for a licensed fund management firm, or it's impossible. Honestly, it's hard. It's really impossible for them to conduct. If they try to do that, they'll get a love letter from the authorities very, very, very soon. Actually, to be very honest, the asset management industry in Malaysia is actually a very, very well regulated and very safe. Because honestly, the SC is really prioritizing retail investors. So anything as long as due to protection of investors, they take it very, very seriously. In fact, the fund management industry is in Malaysia is one of the most stringent. If you look at it in this region, we are really, really, very, very, very stringent. Not easy to be in the industry. So for pump and dump to be due to the professional management industry is impossible. Most of it are done by out of the industry. Yeah.
So pump and dump does happen.
Out of the industry, not due to the fund management industry, people or fund managers within the asset management industry. It is more by outside of the industry. Yeah.
I see. Okay, I've got this question from 𝐊𝐸𝒂𝒓𝒊𝒕𝒚 𝑫𝒓𝒊𝒗𝒆. I think this is quite a good one. So you talk about one of your mistakes was actually falling in love with your stock, right? So it means it means like we don't sell it when we should, right? But how do you actually know when is the best time to sell? Because say, for example, there's a multi-bagger and you get out at a 200% gain. Possibly it could be a 2000% gain, right? So how do we know when we are falling in love with a stock?
See, I think if I use back my own experience, right? My usual argument to myself is I'm a value investor. So it became a very convenient excuse not to sell when you should. So whenever it's time to sell, I will tell myself, no, I'm a long-term investor, I'm a value investor, and I should hold this for long term. Okay, now the question is, when is an indication to sell? It's actually based on really, see, as a value investor or long-term, it doesn't mean you must buy and forget it and hold it for the rest of your life. It's not that, yeah. Value investor simply means at the point of purchase is cheap, that is undervalued, and when it reaches the overvaluation time, by all means sell. No, it doesn't mean when. So how do you decide when to sell? Again, it's valuation. When it reaches a time where the valuation is just way too high, and no matter how optimistic the future growth is, it doesn't justify that kind of valuation. That is actually your first signal to sell. And I said I fall for that very often. When I know that the valuation is high, but simply because we fell in love, we tend to tell ourselves, no, the growth will be so good that it's worth paying for this, and whatnot. So long and short, I think the answer is back to valuation. If the valuation has reached a level which you think is not justifiable even with the future growth, by all means, take profit. Don't make the same mistake as me, where we try to use, or where I try to use value investing as a defense for not doing anything, for not selling. Okay, in that sense, yeah.
Yeah, actually, I remember one experience. We got into Padini at $1 plus. It went up to $6. I didn't manage to cash out, right? Just to see it coming back down to, I think, what, 2 plus, right? So yeah, selling is really psychology, and it's also a skill set. It's much easier to buy than to sell. I mean that's
actually it's true. Actually, buying is the easy part. Selling is the difficult part.
Yeah, when right. Now I have a few questions here, which so one is asked by Lim Tze Cheng. So he talks about companies with high PEs, right? Is that a main criteria for you to decide whether to stay in? Is PE is that the deciding point? Because like, would you invest in a PE that is very high as well? Yeah. This is actually a combination of a few questions. Yeah.
Again, in investing, there is no fixed formula, or there's no fixed conclusion saying that if it goes above this PE is high, it goes above this PE is low. It's always, as I always said, investing is an art. That is why it's so interesting in the sense some people make money and some people lose money. This is really an art, because if it's really a science, right, where people can follow, if it surpass this PE is expensive, it's below this price, then actually there'll be a normal profit, because everybody will react exactly the same way in that sense. One of a few gauge, this more again more of a guide, not a hard and fast rule. Look at the industry PE. Whether is this company's PE is substantially much higher than the industry PE. If it's substantially much higher, then relook into it. Is there any justification for that? But if it's the nature of the industry to have that kind of PE, and the company is trading at that PE level, which is similar to the industry, then it may not be a high PE or may not be expensive in that sense. Take glove industry, for instance, right? I always told this story in the sense, if for those who remember 2010, if you invest in glove in 2010, or you're looking at glove sector, right? In 2010, the average PE for glove is not more than 18 times, 15 to 18 times on 2010. So that time, a lot of people try to justify saying that, hey, glove is healthcare, that it should trade at a 30 to 40 times PE, which is where the healthcare is, or hospital, more exact, where hospital is, right? But I'm not sure if you believe it. For those who really remember or who started investing way back then, nobody buys that argument. For all the investors, glove is a manufacturing business. So a manufacturing business, the most you're only qualified for up to 18 or even 20 times PE to the max. Look at where are we now? Now everybody is talking about glove is a healthcare industry, and that's why some companies are even trading as high as 50 to 60 times PE multiple, right? So again, use a comparison of industry. So will you say that 50 times or 40 times is high for a glove? Again, it depends. It is because it's not absolute. You look at it on a manufacturing perspective, yes, 50, 60 times is extremely high. But if you look at the nature of the industry of medical, then 50, 60 is something that is become quite acceptable for investors. So long and short, there's really no hard and fast rule about what PE is high, what PE is low. There's a lot of factors to take into consideration before we can conclude on that.
Okay, I also got asked the same question today, so I thought, yeah. Okay. So I think this is probably the last one that we can have, because 9:15 our Mandarin session starts. So I'm just gonna pick one here. Okay. So what is this from Amir Hisham? Okay. What is your best way to measure valuation in your opinion? What is the best valuation method, or best way to measure a company's value?
Okay. Again, it depends on a lot of factors. Every company you value it very, very differently. You don't use a single measurement and use it across the board. I think that's something that we have to understand. No, you cannot value all companies using a standard valuation approach, because there's a lot of intricacies within a company that you look at. I give a very simple example, right? For those who remember retailing companies, of course, previously we have Parkson. But if you look at regional, we've got a lot of retailing companies. You have dairy farm in Singapore, right? You have quite a few in Thailand. You have Indonesia. You also have quite a few. And you get normally their PE will be around 30 over times to 40 over times PE multiple. So way back then, I find it quite curious. Why is it all these retailing companies are trading such high PE valuation? Because if you look at retailing, right, their net margin is only around 3%. So for 3% business, why would people? So what I did was I tried to explore other approach. So that time what I came up with, I came up with this approach, price to cash flow. So I take the market cap, I divide by the operating cash flow. And what I found out was purely, I don't know, is it a purely coincidental or purely a market force in play? I find that on average in the long term, this was way back in 2009. I haven't updated for the last 11 years. This is based on 2009. I haven't, because there's really not much retailing to look at in Malaysia now. So I really didn't update. But what I realized in 2009 was somehow all these companies, no matter where they are, be it Thailand, Philippines, Malaysia, or Indonesia, or Singapore, they will come to a number of 17 times. And that is the natural long term. Mean to say, somehow most fair value for a retailing business is 17 times price to operating cash flow, or market cap over operating cash flow. Why is it 70 times? I don't know. But when I did my back testing, it somehow just falls there, right? So that means when you look at retailing, you're using a very different kind of valuation approach. You no longer use PE. When you look at banking, you're looking at how much of their return on equity as a price to book and return on equity as the two foremost valuation for banks. You look at property, you look at what is their present value of their land banks or their net land banks that they have. So really different type of businesses require very different valuation approach. it's very hard for you to actually fix a single approach and apply it across all the industries.
So there's no secret formula, that's what you're saying.
It's an art. It's an art. It's an art. I mean, for those who look at now the world's most expensive painting, I think, is Vincent van Gogh's Starry, Starry Night. If you look at it, try to Google it. I always did this experiment with most of my students. 50% would think it's ugly, and 50. What I do, I show them the picture. I didn't tell what is it. I said, look at this picture. You know, do this ugly or beautiful. Most of the time, I get 50% think it's ugly, and 50% think it's beautiful. But you see, whether we think it's ugly or beautiful, like it or not, it is currently the world's most expensive painting. So likewise, is investing. You know, if people look at a company and say, hey, you know, this is expensive. But you know, another fellow look at it, this is cheap. But in the end, who is wrong and who is right is only the long term, where the share price reaction will tell you that who is right and who is wrong.
Yeah. So if you want, since Peter hasn't updated since 2009, if you sign up for the right, you can get your price over operating cash flow. Right? It's under the profile link. All the companies are there under ratios, and it says it's updated for you for all companies. Okay? So price of over operating cash flow. Right? That's done for you every single day for all companies, right? I had point. Look, so thank you guys for joining us. We are out of time. Our Mandarin session starts at 9:15. Now, don't forget, our ET online campus is also done in Mandarin as well. Okay, so that's also a 100 ringgit donation, and you can also invite 3 friends. So it's under ET online campus, and the Chinese words behind it. So there's 2 different ones. Okay, so that's also so if you prefer the Mandarin one, you can also go to the Mandarin one. But if you understand both, you can sign up for both. Ricky is running it with 𝐕𝒂𝒓, and myself and Benny is running the English one. All right. That's all the time we have for tonight. Thank you very much, everyone, for tuning in.
Can I mention the light version they can download from our WhatsApp, right?
Yes.
The light version.
If you want a light version of Peter's book, you can actually send us a WhatsApp. It's actually under number 1, KopiTime freebies. You can actually download it directly on your WhatsApp. All right. If you haven't set up your account yet, please send us a WhatsApp at 03-8408-2070. I repeat, WhatsApp us at 8408-2070, because we still get people emailing us, WhatsApping us, and calling. How do I sign up for a free account, right? We still get that every day, right? And my team is just really, really patient. So if you can also tell your friends, you can just set it up yourself. It is self-serve, all right? Thank you very much for joining us tonight. See you guys tomorrow. We will be talking about gold. Benny will be back with 2 other experts to see where gold likely will end up. All right. Thank you very much. Good night, guys.
Thank you. Good night.
Thank you.